During this week, you will take a closer look at the balance sheet for a company, including the related financial statement disclosures. The balance sheet is an important financial statement in that it provides a picture of the financial well-being of a company and, more importantly, embodies the accounting equation that a company's assets equal claims to those assets in the forms of liabilities and equity. The first concept you will learn in week 3 is the purpose of the balance sheet and its stated limitations. By the end of the week, you will be able to identify and describe the various balance sheet classifications. Lastly, by preparing a classified balance sheet for a firm, you will have the opportunity to put all your newfound theory and knowledge into practice. This week's material will wrap up by introducing the liquidity and solvency ratios used by a company to assess the firm's financial risk. Where would we be without a little humor? We're in good shape. Nobody understands our financial statements. Now, isn't that the truth of it? I often share with my students that financial statements tell a story, and it is truly our talent as future accountants that sets us apart as we can start to take this complex financial statement information and articulate it through first, the balance sheet to inform external users of the financial well-being of our organization. Like all good stories, we begin with a value proposition or usefulness of the balance sheet. The balance sheet embodies the basic accounting equation: assets equal liabilities plus owner's equity. The balance sheet provides a list of assets and liabilities that are classified or grouped according to common characteristics, which will be discussed throughout the chapter. The balance sheet goes on to assist in the evaluation of liquidity being defined as the ability of a company to convert its assets into cash to pay its current liabilities. Solvency, which refers to an assessment of whether the company can pay its debt. And finally, solvency also provides information about financial flexibility. Financial flexibility is one of my favorite topics as it assesses the ability of a company to alter cash flows to take advantage of unexpected investment opportunities and needs. This is thinking about perhaps us not living paycheck to paycheck. And as we find something that perhaps we've been saving up for and it goes on sale or provides additional value to us, we're able to take advantage of that opportunity. And then finally, the balance sheet aids in the assessment of risk or predicting future cash flows by looking at perhaps something like accounts receivable, as we can see when those will come full circle and turn into cash. There are two primary reasons that the current market value is not reflected for all items on the balance sheet. Like many assets, including land and buildings, they are measured at their historical cost rather than amounts that assets could be sold for, often referred to as assets' fair value. For example, suppose the company owns the land and the amount for which that land could be sold increases. The increase in land's fair value is not reported on the balance sheet, so it has no impact on the company's book value defined as assets less liabilities. However, to the extent the increase of the land's fair value is known by investors, it will increase the overall company's market value. Many aspects of a company represent valuable resources, such as trained employees and an experienced management team. However, these are not recorded as assets in the balance sheet and therefore have zero impact on book value. Investors understand the ability of these resources to generate future profits and therefore will assess these resources in the compilation of the overall market value. Another limitation of the balance sheet is that many items on the balance sheet are reported and heavily reliant on estimates and judgments rather than determinable amounts. For example, companies need to estimate the expected number of accounts receivable they will collect, the amount of warranty costs they might incur, residual values or salvage values, or useful life for long-term assets, and amounts used to calculate various obligations. Each of these estimates is impacted on the balance sheet. The usefulness of the balance sheet is enhanced when assets and liabilities are grouped according to common characteristics. The broad distinctions made in the balance sheet are current versus long-term or non-current, classifications of both assets and liabilities, which are determined based on the relationship to the operating cycle. The operating cycle for a typical merchandising or manufacturing company is defined as the period from the initial outlay of cash for the purchase of inventory or raw materials until the time the company expects to collect cash from customers from the sale of such inventory. With that framework and understanding of the operating cycle, we move forward into the classifications in the balance sheet. Assets are defined as probable future economic benefits obtained or controlled by a particular entity because of past transactions or events. Asset classifications are grouped as follows: current assets, long-term investments, property, plant and equipment, intangible assets, and other assets. Current assets are defined as cash and other assets a company expects to convert into cash, sell, or consume either in 1 year or in the operating cycle, whichever is longer. Current assets include cash and cash equivalents, short-term investments, receivables, inventories, and prepaid expenses. Cash and cash equivalents are defined as follows. Cash includes cash on hand and cash in banks that is available for use in operations of the business, such as bank drafts, cashier's checks, or money orders. Cash equivalents are defined as short-term investments that have a maturity date no longer than 3 months from the date of purchase. Short-term investments are investments in stock and debt securities of other corporations that a company has the ability and intent to sell within the next 12 months or an operating cycle, whichever is longer. These investments can be classified based on the intent and ability to sell and will be discussed in more detail in Chapter 12. Receivables represent claims against customers or others for money, goods, or services. Trade receivables are most often referred to as accounts receivable as they arrive during a company's normal trade and/or business with customers. Non-trade receivables result from loans or advances by the company to individuals or other entities. Notes receivable are supported by a more formal agreement or note that specifies payment terms and other obligations. Inventory is defined as an asset that a company holds for sale in the ordinary course of business or goods that it will use or consume in the production of goods to be sold. Classifications include raw materials, work in process, and finished goods and will be discussed in more detail in subsequent chapters as well. A prepaid asset is an asset that arises when a company incurs a cost of acquiring an asset in one period that won't be used or expensed until a future period. Current or non-current depends on the period in which the item is expected to be consumed. Examples include supplies, prepaid rent, and prepaid insurance. Non-current assets include long-term investments, property, plant and equipment, intangible assets, and a catch-all for other assets. Investments are assets that are not used directly in the operations of a business. These assets include investments in equity and debt securities of other corporations, land held for speculation, long-term receivables, and cash set aside for special purposes, such as future plant expansion. These assets are classified as long-term because management does not intend to convert these assets into cash in the next year or the operating cycle if that's longer. Tangible, long-lived assets used in operations are classified as property, plant, and equipment, fixed assets, or plant assets. We often hear these terms used interchangeably. Property, plant, and equipment, also referred to as PPE, along with intangible assets, are often the primary revenue-generating assets of the business. These various assets generally are reported as a single amount on the balance sheet, with details provided in the footnotes. They are reported at the original cost less accumulated depreciation to date. Some assets used in operations have no physical substance. These are appropriately called intangible assets. Generally, these assets represent the ownership of exclusive rights to something such as a product, process, or name, and can be a valuable resource in generating future revenues. Patents, copyrights, franchises, and trademarks are all examples. They are generally reported in the balance sheet at their purchase price, less accumulated amortization. Now we turn to the first of two claims on the assets of the organization. Liabilities represent probable future sacrifices of economic benefit arising from present obligations of a particular entity to either transfer assets or provide services to other entities in the future because of past transactions. We will specifically focus on current liabilities and long-term debt. Current liabilities represent obligations that a company reasonably expects to liquidate through either the use of current assets or the creation of other current liabilities. We will specifically focus on accounts payable, notes payable, unearned or deferred revenues, accrued expenses, salaries payable, income taxes, payable, and current portions of long-term debt. Accounts payable are obligations of either suppliers of merchandise or services purchased on account, usually with payment terms ranging from 30 to 60 days. Notes payable are written promises to pay cash at some future date. Unlike accounts payable, notes usually require the payment of explicit interest in addition to the original obligation amount. Deferred revenue, sometimes called unearned revenue, represent cash received in advance from customers to be provided in return for goods or services provided in the future. For example, a company records deferred revenue when it sells gift cards. Revenue is not recorded until those gift cards are redeemed by the customer. Accrued liabilities represent obligations when expenses have been incurred, but the amounts are still owed and not paid in cash until a subsequent reporting period. Salaries payable and income tax payable represent examples of these accrued expenses. And finally, current maturities of long-term debt refer to the portion of long-term notes, loans, mortgages, or bonds payable that are payable within the next year. For example, if we had a $1 million note payable requiring $100,000 in principal payment to be made in the next 12 months, we would include that as a current portion of that long-term debt. Long-term liabilities are obligations that are due to be settled in 1 year or operating cycle if that is longer from the balance sheet date. Long-term liabilities represent long-term notes payable, bonds payable, lease obligations, and pension obligations. Keep in mind, by simply classifying a liability as long-term doesn't provide a lot of information to external users. For instance, long-term could be anything from 2 to 20 years or even 30 years or 60 years. Payment terms, interest rates, and other details are needed to assess the impact of these obligations on future cash flows and long-term solvency, and are reported in the footnote disclosures. Owner's equity is simply the total assets minus total liabilities. For that reason, is sometimes referred to as net assets or the book value of a company, because owners of a corporation are shareholders. Owner's equity for a corporation is typically referred to as shareholder equity or stockholders' equity. Shareholder equity for a corporation arises from primarily paid-in capital and retained earnings. Paid-in capital is the amount that shareholders have invested in the company. It most often arises when a company issues stock. Information about the number of shares the company has authorized and how many shares have been issued and are outstanding must be disclosed either directly on the balance sheet or in a footnote disclosure. Retained earnings represent the accumulated net income reported by the company since its inception, minus all dividends distributed to shareholders. And a third and final component of shareholders' equity is accumulated other comprehensive income. All other comprehensive income refers to the changes in stockholders' equity other than transactions with owners and other than transactions that affect net income. We accumulate these items of comprehensive income in the accumulated other comprehensive income account, just like we accumulate each year's net income in retained earnings. This will be discussed in more detail in Chapter 4. Next, we move to financial statement disclosures. The goal of financial statement disclosures is to disclose as completely as possible all pertinent information that is not otherwise seen on the face of the financial statement. The first is a parenthetical explanation. This would be reported on the balance sheet itself. For example, net of tax or net of depreciation. The second is the footnote disclosures on the financial statement. One example that we'll explore in more detail is the summary of significant accounting policies. The third is either a cross-reference or a contra item. For example, we might have accounts receivable and its contra item of allowance for doubtful accounts or allowance for bad debt. And fourth is supporting schedules, for example, lease payment disclosures. Another example might be the long-term liability that we talked about, where we'd want to know what the payment schedule might be, the interest rates, and so on. Companies are required to disclose significant accounting policies. GAAP recommends a description of all significant accounting principles and methods, specifically when they involve selection among alternatives. For example, LIFO and FIFO. Companies are also required to disclose information about the risks and uncertainties involved in their operations. And finally, companies must also disclose the nature of their operations, the use of estimates in preparing the financial statements, certain significant estimates, and their vulnerabilities. Companies must also disclose subsequent events, which is a material event that occurs after the fiscal year but before the financial statements are issued. The auditor's report is the culmination of when the auditors examine the financial statements and the internal control procedures and attest to the fairness of the financial statements. This results in an opinion stated in the auditor's report. There are 4 basic types of auditor's reports: unqualified, unqualified with an explanatory or emphasis paragraph, qualified, or adverse or disclaimer. When an auditor issues an unqualified or clean opinion, the auditor has undertaken professional care to ensure that the financial statements are fairly presented in conformance with generally accepted accounting principles. Professional care would be sufficient in planning the audit, understanding the company's internal control procedures, and gathering the necessary evidence to attest to the accuracy of the amounts reported in financial statements. In some cases, the auditor has an opinion that is unqualified with an explanatory paragraph. In these circumstances, the auditor believes the financial statements are in conformity with GAAP, but the auditor feels that other important information needs to be emphasized to the financial statement user. A qualified opinion results when the audit process is either limited, either a scope limitation, or there has been a departure from GAAP. But neither is sufficient or serious enough to invalidate the financial statement. An adverse opinion is when the auditor has specific knowledge that the financial statements or disclosures are seriously misstated or leading. Adverse opinions are rare because auditors are typically able to persuade management to rectify these problems to avoid this undesirable report. And then finally, a disclaimer is when the auditor is not able to gather sufficient information to represent that the financial statements are reported in conformity with GAAP. Trying to gain a glimpse into the future from the past and present data entails using various tools and techniques to formulate predictions. This is the goal of financial statement analysis. Common methods for analyzing financial statements include the following. A comparative financial statement or financial statements are accompanied by corresponding financial statement information from the preceding year and most often the previous 2 years. Horizontal analysis, where each item in the financial statement is expressed as a percentage of that same item in the financial statement of another year. For example, comparing inventory last year to this year would provide the percentage change in inventory. Vertical analysis represents each item in the financial statement expressed as a percentage of the appropriate corresponding total or based amount, but within the same year. For example, cash receivables and inventory in the current year can be restated as a percentage of total assets in the current year. And finally, ratio analysis. Financial statement items are converted into ratios for evaluating the company's performance and risk, and we will turn to this topic in closing the chapter. In the context of this chapter, we will focus on financial statement analysis, embodying liquidity and solvency ratios. Liquidity, as discussed earlier, most often refers to the company's ability to convert assets into cash to pay its current obligations. By examining a company's liquidity, we can generally obtain an idea of the firm's ability to pay its short-term debts as they come due. Current assets are usually thought to be implied as a company's most liquid assets because these assets are easier to convert to cash than long-term assets. Obviously, though, some current assets are more liquid than others. Two common measures of liquidity are the current ratio and the asset test ratio in working capital. The current ratio can be calculated by dividing current assets by current liabilities. And on the other hand, the asset test ratio can be calculated by dividing the quick assets by the current liabilities. Working capital is defined as current assets less current liabilities. In closing, we review the solvency ratios. Solvency ratios provide some indication of the riskiness of a company with regard to its ability to pay its debts. Investors and creditors, particularly creditors, are vitally interested in solvency. Two common solvency ratios are the debt-to-equity ratio and the times interest earned ratio. The debt-to-equity ratio is calculated by dividing the current total liabilities, both current and non-current, by total stockholders' equity, including retained earnings, whereas the times interest earned ratio is calculated as net income before subtracting interest expense and income taxes divided by interest expense. Since net income is computed by deducting interest, expense, and income tax expense, we must add them back to compute income before interest expense and income tax.